Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in new residential construction for investors in the Oklahoma City and Tulsa markets. If you're like me, you're following interest rates all the time. I mean, it's very important to me in terms of my business, but we're talking about two different kinds of interest rates today. Number one is short-term interest rates. In other words, you go to get a signature loan at a bank, or you say, I'm going to finance my car for 3 years or 5 years. That's one rate. The other is a rate that is a mortgage rate. In other words, you're looking for a 30-year fixed mortgage. So how do we determine this? Well, first of all, let's talk about treasuries. Let's talk about the debt that the United States has, that what we have to do is we have to sell treasury bills in order to pay for that debt. So about $1 trillion a year right now. So the benchmark that we really follow most of the time is the 10-year treasury. So a month and a half ago, the 10-year treasury was about 4%. Right now, it's above 4.2%. Now, here's the thing. The treasuries are based on what we have to sell, the auctions of treasuries. And in that case, we've got to give enough yield in the United States in order to get, especially a lot of foreign buyers from Japan, China, the European Union, for instance, to buy these. So at the same time that we've gone up in the 10-year treasury, a lot of people say, well, good grief, that means the mortgage rates are up. Well, that's not the case. Right now, mortgage rates are down because it's a mortgage-backed security. It's a separate purchase. Now, one of the things that's happened recently is quantitative easing, which we were familiar with during COVID, where the treasuries were buying their own, the Treasury was buying their own treasury to keep the rates down for you. In this case, we have about $200 billion that's being used by the federal government to buy mortgage-backed securities. And so things have gone down. So there's not really a correlation that's absolute between the 10-year treasury telling you what's going on with mortgages. And I want to make that very, very clear because sometimes people misinterpret. Now, the 10-year treasury does have effect on one thing, and that is, it is something that mortgage companies use to determine interest rate buy downs. In other words, what they're trying to do, if you take a 5.375% par rate that I just talked about in the previous video versus 4.75, they're going to figure the amount of points it takes to get down to that mortgage rate. Because essentially what the mortgage company wants to do is get their money back in 10 years. And so in that particular case, yes, the 10-year may have an effect in terms of how they determine what it costs to buy down to various rates from 5.375 to 5.125 and down to 4.75. So that is the situation. So if you're following the treasuries, yes, that 1 year, the 3 year, the 5 year, for instance, they're going to have a major impact on what happens when you go to the bank or the car lot. In the case of mortgage-backed securities, it's something totally different. And right now, they're really, really good. Our big builders, as I said before, are putting out millions of dollars to buy the rates down before it comes to you. Then you can use that percentage based on maybe the 10-year treasury to figure out how to get it down further.